SoFi stock has been on an absolute tear, at one point surging more than 200% from its low over the past year. The company just reported record revenue and added a mind-boggling 850,000 new members in a single quarter. The growth has been nothing short of explosive, but with the stock hovering near its 52-week highs, the big question on every investor's mind is, did we miss the boat, or is this a dangerously overvalued trap? Is the hype real, or is this a bubble just waiting to pop? Well, we're about to find out. We're going to break down a powerful bull case for why the stock could keep climbing, and then play devil's advocate with the bear case, the serious risks that might make you think twice. We look at what top Wall Street analysts are saying, and by the end you'll have a clear picture to help you decide if SoFi is a smart buy for your portfolio right now. Okay, so first up is the bull case. To really get why SoFi has been on this incredible run, you have to look at its staggering growth. Let's start with member growth. In the second quarter of 2025 alone, SoFi brought in a record 850,000 new members. No, that's not a typo. The total member base has now swelled to over 11.7 million. That's a 34% jump from last year. This company isn't just growing, it's accelerating. People are flocking to SoFi's platform. But what's even more impressive is how SoFi gets its customers to use more of its service. The company added 1.26 million new products in the same quarter for a new total of 17.1 million. This shows that once someone joins, they don't just stop at one product. They might just start with a checking account, then add an investment account, and then maybe grab a credit card or a personal loan. In fact, existing members accounted for over 35% of new products sold in the quarter. This is what the CEO Anthony Noto calls the financial service productivity loop. Think of it like a flywheel that's just spinning faster and faster, creating super loyal customers and cutting down a cost of finding new revenue. Now let's follow the money. All of those new members and products are fueling record-breaking revenue. In Q2 2025, SoFi's adjusted net revenue hit $858 million, a 44% surge from the year before and its highest growth rate in over 2 years. The company is so confident it raised its full year 2025 revenue forecast to about $3.3 billion, which would be 30% annual growth. But here's what's really getting the bulls excited: where the money is coming from. SoFi is making a smart pivot away from just being a lender and toward a more stable fee-based model. In the second quarter, fee revenue shot up 72% year over year, a record $378 million. This is a big deal because fee income from services like their tech platform, loan referrals, and credit card interchange is more predictable and often more profitable. This shift helps protect the business from the ups and downs of interest rates, which is a huge plus. And finally, the crown jewel for the bulls, well, profit. For years, the big criticism of SoFi was that it was all growth, no profit. Well, consider that story dead. SoFi has now delivered 7 consecutive quarters of GAAP profitability. It didn't just barely make it either, it posted $97 million in net income last quarter with earnings per share of 8 cents, blowing past what analysts expected. The company's adjusted EBITDA margins has expanded to 29%, showing incredible efficiency. As SoFi gets bigger, it's getting more profitable. So let's quickly recap the bull case here. You've got explosive member growth, a stick product ecosystem that's a cross-selling machine, record-breaking revenue that's shifting to a more stable model, and a clear proven track record of growing profitability. It's a very compelling story. Okay, with all that amazing growth, there has to be some catch, right? Well, that brings us to the bear case, and it boils down to 2 big things: a sky-high valuation and some serious red flags from Wall Street analysts. The most obvious concern is the stock's price. After running up so dramatically, you could argue a lot of good news is already priced in. As of mid-October 2025, the stock is trading around $26 to $27 a share, which is near its 52-week high. This is what we call a premium valuation. The market isn't pricing SoFi on its performance today, it's pricing it for a nearly perfect execution for years into the future. When you pay a premium price, there's no room for error. Any stumble or a sign of slowing growth could cause the stock to fall hard and fast. This is exactly why Wall Street analysts are hesitant despite the great headlines. The consensus rating from analysts is a hold. Let's break that down. Of about 22 analysts covering SoFi, only 6 or 7 rate, that is not a funny meme by the way, rate it a buy. The majority, around 12, say hold, and 3 to 4 have an outright sell rating. That is not the roaring endorsement you'd expect for a company with these growth numbers. It shows just how divided and uncertain analysts are. And here's where it gets a little scary for anyone thinking of buying now. The average 12-month price target from these same analysts is somewhere between $20 to $22. With the stock currently trading well above that at $26, the experts are implying a potential downside of 17 to 22% over the next year. Sure, there are bulls like Mitsubishi Dan Dolev with a $31 price target, but there are plenty of bears too. Firms like Morgan Stanley and Keefe Bruyette and Woods have sell or underweight ratings with price target as low as $18. Their worries go beyond just valuation. The bears also point to the brutal competition in fintech. SoFi isn't exactly playing in an empty field. It's up against a wave of new startups and, more importantly, the giants like JP Morgan and Bank of America, who are pouring billions into their own digital apps. Trying to maintain 30% growth against the kind of competition is a huge challenge. Finally, there's still a risk in the lending business. While SoFi is diversifying, personal and student loans are still a major part of the company. That business is tied to the economy. If a recession hits or more people lose their jobs, loans default could tick up and hit SoFi's bottom line. So the bear case is pretty straightforward. The stock seems priced for perfection, the Wall Street pros are split, and their average price target suggests it's overvalued. On top of that, it faces fierce competition in an economically sensitive industry. So we've seen the powerful bull case and the very real risk in the bear case. Where does that leave us? Is SoFi a buy right now? This is your classic growth versus valuation puzzle. On one side, SoFi is executing beautifully. The member growth is off the charts, the product ecosystem is working, and the company is constantly profitable on a GAAP basis. The holy grail for a company like this. CEO Anthony Noto has a clear vision and his team is delivering, even raising guidance for 2025. That kind of momentum is tough to bet against. On the other side, the market knows all of this. The stock's huge run reflects that optimism and the valuation is stretched. The hold rating from analysts and that average price target below the current stock price are warning signs you can't ignore. Buying here means you're betting that SoFi will not only meet but crush already high expectations. For me, at its current price, SoFi is a hold. It's a fantastic company, but the stock just looks fully valued right now. The risk versus reward simply isn't compelling enough to jump in at a new position near its 52 weeks high. That said, this is absolutely a strong buy on a dip candidate for my watch list. I would get very interested in starting a position if the stock were to pull back into the low 20s, much closer to that consensus analyst price target. A price in that range would offer a much better margin of safety to buy into this incredible growth story without overpaying. The next big event will be the third quarter earnings report expected on October 28. Wall Street is looking for an EPS of $0.08 on 27% revenue growth. If SoFi can beat those estimates again and raise its guidance, the stock could take off, but any sign of slowing down could easily send the stock back toward those analyst targets. Now remember, this is all for educational purpose and should not be taken as financial advice. Always do your own research and make decisions that fit your personal risk tolerance. If you got some value out of this breakdown, do me a quick favor and hit that subscribe button and turn on notifications. I sometimes break down the hottest stocks to help you become a smarter, more informed investor. It's a free and helps the channel out a ton. So to bring it all together, SoFi is a phenomenal growth story. The company is firing all cylinders with incredible member growth, deeper product engagement, and a solid track record of profitability. The bull case is backed by solid numbers. However, the market has already rewarded this success with a premium valuation that seemed to have priced in years of future growth. The caution hold consensus from Wall Street analysts echoes this reality. It's a great company, but it might be a fully priced stock. For now, the smart play seems to be watching from the sidelines. Keep SoFi at the top of your watch list. It has the potential to be a defining company in the future of finance and a huge long-term winner, but a little patience might reward you with a much better entry point. But hey, that's just my take. I really want to know what you think of SoFi. Is SoFi a generational buying opportunity, or is the hype just getting ahead of the fundamentals? Drop your price targets for SoFi in the comments below. I read all of them. Thank you for watching.